Hello everyone, this is Brandon Garrett from Ben Oak Capital with our August economic update. In this month's video, I will highlight what we're seeing in the markets and what that means for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. One of the most common questions we get right now is how can the U.S. economy be struggling while the stock market keeps churning higher? Even harder to answer questions are, when will that gap close and what will be the catalyst that starts to close it? So, how can we make sense of the recent rally? The stock market continues to do quite well. The S&P 500 index, which has risen 4 straight months, is now positive so far in 2020, despite probably the worst pandemic in the United States in 100 years and one of the sharpest economic contractions since the Great Depression. How does that make sense? Let's start with some context for the stock market's recent strength. First, the pandemic has an end date. Markets are looking forward to better days ahead. Although the timing is uncertain, the stock market is expressing confidence that the pandemic will end eventually with a vaccine or multiple vaccines, and with help from better treatments in the interim. Progress has been tremendous with many success stories. Secondly, interest rates are extremely low. Stocks are expensive, no doubt, but they look cheap compared with U.S. Treasuries yielding about 0.5%. When discounting future profits back at such low interest rates, equity valuations get a significant boost. Next, we have seen massive monetary stimulus. Some of that money has found a home in the stock market. Historically, money supply growth and stock prices have tended to move together, which has certainly been the case over the past few months. And lastly, yet most notably, the support from the winners. The so-called stay-at-home stocks have thrived in this environment. We saw evidence of that in the blowout earnings reports from some of the technology giants on July 30th. The good news extends beyond those companies, however, with about 40% of the S&P 500 classified as technology, digital media, or e-commerce. Capital investment has been supported by technology spending, which has not been hit as hard as consumer spending during the pandemic. As a result, the S&P 500 has been more resilient to the pandemic. Add in some of the most defensive industries within the consumer staples, telecom, and utility sectors, and more than half of the index is well positioned for this difficult environment. By discussing the factors behind the strong rally, we don't mean to imply the rally will keep going uninterrupted. Stocks may likely face bouts of volatility over the rest of the year with upcoming elections and uncertainty around a COVID-19 vaccine, which is why we remain cautious. We will share more of our thoughts about our second half 2020 expectations and potential election implications in the coming weeks and months. That's it for our August 2020 economic update. If you have any questions about what was discussed, please give us a call at 817-550-6750.